Some things have not changed. Cash flow is still king. That's the primary source of repayment. When a bank gives you a loan, they just want to make sure you can repay it through normal cash flow. Collateral is still important. That's the secondary repayment area that banks will look for. If something does go wrong in the cash flow, they're going to look back and say, okay, what collateralizes this loan? Can I sell the building? Could I liquidate the equipment? Do I have receivables? Do they have inventory? Worst case scenario, could I go in and sell that and get repaid? Management team, especially the financial team, becoming even more important. With the increased banking regulations, and I'm going to ask both Tom and Lou a question here in just a second about how it's impacting them, but timely information, getting information to your banker on a timely basis is going to become critical going forward. There's going to be implications to the banks when the reviewers come in. These guys get overseen by both either FDIC or OTS. And when they come in, I was a CFO in my prior history, when they come into your bank, what they do is they pull loan files. And if those loan files say the financial statements are supposed to be there in 120 days, and they pull the file and the financial statement is not in there in 120 days, they're going to risk rate that loan, and they're going to put pressure on the people like Tom and Lou to say, why didn't you get this financial statement? We want to increase the reserves on this because now you're not getting timely information from your client. You have it in the loan agreement. They're supposed to be giving it to you, and you're not making them comply. I've been in part of those conversations, and they're not nice. And they're talking, so and they're reporting, so that has implications to the earnings of the bank because they need to increase the reserves. They're going to need more cash on their balance sheets. They need more equity. It's not a good situation when that happens, and it's not getting better for these guys. The regulations are definitely getting up. The other advisors that the company partners with, are they vendors or partners with the company? We talk about that a lot with clients. To make sure you're partnering with your bank. Don't treat your bank as a vendor. It's more about, it's not all about the interest rate that you have. I know, sometimes when you're on the golf course and you hear, your buddy has, prime minus a half, prime minus one, whatever. But the loan terms, the covenants and everything surrounding that also are very important. I can tell you the clients that have that prime minus a half, prime minus one are usually very strong balance sheets, but most of those clients can't afford to slip because what's happening is you're squeezing the margins at the bank, and when you slip, they don't have any room to help you. They immediately need to take some pretty aggressive action to make sure it's corrected to maintain that loan rate, or they need to increase the rate pretty quickly at a pretty fast pace. So partnering with your bank is very important. I mean, we'll talk a little more about what that means, but it's more communication, telling them the good, telling them the bad, telling them the business risk that you consider business risks, and listening to them of what they consider the business risk from their side.